here to discuss week in Silicon Valley. This is the first data slide. What we're doing here is we're comparing the active number of listings today compared to the median for the past 10 years for the same week. Red in color means there's less inventory, which would favor the seller. The one exception down here is Redwood City, where it's blue in color because it's got 130% of the normal expected inventory. There's a couple areas in San Mateo County that are right at 100%, and Cupertino and Sunnyvale in Santa Clara County is 100%. So 100% is what you'd expect. Red is lower than you would expect. Blue is more than you would expect. Flipping over and looking at the number of offers, the concept is the same, but the colors are reversed because here a low number of offers favors the buyers. And here you can see most of San Mateo County is blue in color, and actually some of Santa Clara County is blue in color, and even Alameda County is blue in color. So that basically says we have a lack of number of transactions, and we'll see that in a few minutes with record low number of transactions. Now we're looking at the DUI compared to the 10-year median, and someone might calculate the numbers by doing a ratio of the active to the number of offers and say my numbers don't jive. The reason that can happen is the median for each of the indicators can be from a different year. If they were all in the same year, the ratio would work. But if one is from 2005 and one's from 2007, then the ratio would not work. So this is still just looking at the DUI indicator, which is the speed indicator. In this case, a low DUI, like in South County of 67%, is a faster paced market. It's taking less time to sell all the homes on the marketplace, so that favors the seller. Moving on, dropping the 10-year median and simply looking at the DUI. And the reason I can do this now is I'm looking at the ratio of inventory to offers in every single micromarket area. So when you have a small micromarket area like Foster City, Redwood Shores, compared to a large area, say Santa Clara, Campbell, Cambrian, Willow Glen, you get when you do a ratio between the number of active listings and the number of offers, just the raw count makes sense. What I consider is basically anything under about 6 weeks, 42 days to be a seller's marketplace. The lower the number, the hotter the marketplace. So you can see in Santa Clara County, you got a fair number of days right around 20, or micromarkets right around 20 days of unsold inventory. You go up into San Mateo County and you go over to the coast and you're at 160 days. So it's 8 times slower on the coast than it is in Silicon Valley. And then if you go into Alameda County, it's starting to look like it's doing a little bit better than Santa Clara County. I would say Santa Clara County, and you have to do a weighted average, so you can't just look at the numbers, but I would say Santa Clara County is 20, where I would say Alameda County is below 20, maybe like 17, 18. So Alameda County is the quickest pace market, and that's because, in my opinion, it's all still related to the pandemic, where people don't feel they need to be as close to work. This is a simpler number for a lot of people to follow, and it's simply of the sellers that are successful in selling, how long were they on the market before they sold? And again, anything under about 3 weeks, I consider to be a seller's marketplace. 3 to 6 weeks, I consider to be a balanced marketplace, and over 6 weeks, I consider to be a buyer's marketplace. So the only buyer's marketplace is Saratoga Las Gatas. Now that might sound a little weird because we had days unsold inventory in the San Mateo coast of something like 160, and now 75% of the successful sellers are selling in 31 days. How is that possible? Well, it's saying that a lot of people are selling quickly, but then the last 25% is taking a long time to sell and bringing up the DUI. And the DUI includes unsuccessful sellers, where the days on market is only those that are successful. This is the ask price reduction. And I introduced this fairly recently. I'm pretty confident it was sometime last year. And it's simply to look at how big the sellers are doing price reductions before the offer comes in. The reason for this metric isn't to look at the raw number, because that doesn't change very much. You can see these are all fairly small numbers, very close to zero. But what it does is it eliminates the time to get the sold price out of escrow. So this tells you market changes. As these numbers go up, that means sellers are taking bigger discounts or more frequent discounts to get their offer in the door. You can see there's a few areas like Saratoga Las Gatas, North San Mateo County, and Oakland that are sort of favoring the buyer right now. But there's basically twice as many micromarket areas that are favoring the seller, and a lot of the areas are neutral. So that's basically saying sellers' expectations are in line with the marketplace for the most part. This is looking at the frequency of price reductions. And here, the less frequent price reductions there are, the hotter the marketplace. So you can see that almost the entire map is red in color. Is one very small shade of blue in Saratoga Las Gatas. There's a couple of fairly faint pinks or potentially white areas. But in general, you can see that there's very few percent of the sellers. This is the percentage of sellers that are reducing their price. So it's less than 25% in Saratoga Las Gatas being the high, to a low of 0% in San Mateo County coast, which almost doesn't make sense. 0% of the sellers are reducing their price, but they have a long time on the marketplace and they have a lot of inventory. There's almost a disconnect here. But again, this is of the sellers that are successful. So it's almost like you have two markets. You have the market that are successful, get the offer. So now we look at their price adjustments and they're selling right away. So you have the realistic price sellers and the unrealistic price sellers in the San Mateo County coast area. This is the magnitude of overbidding. It's looking at what buyers are doing when they come in. The drawback of this metric is you have to wait for escrows to close. So there's about a 5-week delay. Red in color again favors the seller when 8% on average of overbid. So this means if you're asking $1 million, your offers are coming in at $1,080,000, 8% over your ask price. That's pretty good. You can see Saratoga Las Gatas, a small hit. The San Mateo County coast, a 4.5% price reduction. Foster City, very small micro market area for Foster City, a 2.5% price reduction. The only two areas that have a significant price reduction are in San Mateo County. Alameda County's got the highest overbid at 11.4% in Berkeley and the island, the city of Alameda. Here's the frequency of that overbidding. So how common is overbidding? And in Foster City, not one offer went in over the asking price. Now, granted, again, it's a small micro market area. There's probably about 5 offers would be my guess, but none of those buyers came in over asking. In Atherton, only a third, less than a third of the sellers, and in Saratoga Las Gatas, it was right at a third. South County is basically at a third too. So there are some areas where overbidding is not that common, but you come to the heart of Silicon Valley, and it's basically 70 to 75% of those transactions are selling over asking price. You go into Alameda County, and the number is probably closer to 60%, maybe 62%. This is looking at the long-term appreciation of the different micromarket areas since the last 9 months of 2015. So basically April 1st through December 31st of 2015. 83% appreciation in the affordable areas. So most of Santa Clara County, the heart of Santa Clara County, is right around 85%. Cupertino, Sunnyvale, that's basically, a fast-paced marketplace, is only seen 60% appreciation. Saratoga Las Gatas, that's slow, has seen 87% appreciation. So the amount of appreciation does not necessarily tie into market conditions. San Mateo County is pretty low with only about 33% appreciation. So they've clearly taken a hit in recent years after the pandemic. And the high is Pleasanton at 91%. The lowest that I'm seeing on the whole list is Oakland at only 19% appreciation. You could have held on to a property there for approaching 9 years, only seen a 19% return on your money, or you could have bought in Pleasanton and seen a 95% return on your money if you paid all cash. One of the things that's nice about real estate is if you put a 20% down payment, you get 5 times the rate of appreciation on your actual money. Now, instead of following just the median number, which is the middle number between the two vertical lines, as most people do, I sandwich it by following the cheapest 10% over on the left and the most expensive 10% over on the right. So you can quickly see what the market price range is in a given area. And we'll take Atherton just because it's a nice demonstration. From the low end to the high end is basically about $2.5 million. From the median to the high end is about $600,000. That is very common because as you go up in price, the homes are more spread out. They're more densely populated in the lower price range. So your first 40% of your homes is only a $2.5 million range, where your next 40% homes requires a $6 million range to get there. Here is a summary chart. You can start over on the right-hand side with your payments, assuming an 80% loan and a 30-year fixed loan at the federal national average for interest rates for jumbo money, or you can pick your price range, or you can start over on the left-hand side and pick your micro market area and read across. Let's pick Los Altos, Palo Alto. Basically 81% of the active inventory you'd expect. You're at 90% of the offers, so that's doing pretty well. But the DUI is a little bit, which makes sense because the number of offers is above the number of active inventory. So your days of inventory is lower than you would expect. You only have 34 days of inventory currently. 75%, the hot typical seller is selling in 17 days. So in less than 3 weeks, 0.6%. Sellers ask price reduction. 11% of the sellers are doing a price reduction. So if you do quick math, that says that the sellers that are doing price reductions are taking a 5% roughly price decrease. The amount of overbidding, the buyers are coming in 2% over the seller's ask price on average. That includes those that go under. So if you want to look at just those that would be over asking price, it would be a higher percentage. 50% of the sellers are getting more than their ask price. They've seen only a 15% appreciation since 2015. And then the price range is from 2.5 million to, it looks like 5.5 million. Their payments are from about almost $19,000 to $40,000, assuming an 80% loan. Clearly, when you tend to buy the more expensive homes, you've made money on the stock market or a startup company, and you're not doing an 80% loan. But if you did, your payment would be about $40,000 a month. Now we're taking all those 20 micro market areas, putting them in a blender, and looking at the key components. Inventory is down here, and you can see you're at about 73% of where you'd expect it to be. So inventory is lower than you would expect it to be. Offers is basically the same ballpark. It looks like it's about 76% of where you'd expect it to be. And days unsold inventory looks like it's about 92% of where you'd expect it to be. And that's for all three counties. This table here, I like this because I think it's an area that we're not spending enough time on, and that's simply the record low volume of transactions. We've only accepted 1,600 offers in the last 5 weeks. Our previous record low was 1,800, so we're selling 200 fewer homes than we have any time in the past 25 years. So the orange over here is our previous record low. The dark blue over here is our current number. So you can see, and then if you want to look at a percentage, 99%, 97%, 95, 92, 82, 81, 81, 83. So we went from basically equaling our previous record low to 20% below. Then we got back up to about 90%, and that's where we are now. So we're losing 10% of the normal number of transactions that we normally do. And that hurts the industry. It hurts the lenders, it hurts the title and escrow officers, it hurts the real estate industry. There's less total transactions, which means less termite inspections, less home inspections, less appraisals, less commissions for the agents, etc. Now we're looking at the PITI for the cheapest 10% home, and that's down here around 6,000. So if you were buying the cheapest 10% home in Silicon Valley, which would probably be in Alameda County, although you probably could find a fixer-upper in Santa Clara County, your payment would be about $6,000 a month. If you bought the median priced home, it'd be about $1,200 a month, and your most expensive 90% home would be about $25,000 a month. Here we're doing something a little different. We're looking at a week's distribution. So a year ago we were on this dotted line. Right now we're up here at the purple line. So we're doing significantly better this year than we were, and this is price reductions. I'll just step through that. And you can see that a year ago it was glowing up for the summer, then it came back down and was sort of at the up for the spring, plateau for the summer, plateau for the fall. And then pretty soon, right about now, it's right there, it's gonna start jumping up, and you can see how rapidly the market wakes up. The green line was our wake up, and that looks like it was basically January 24th, which, if I'm not mistaken, was the week between the playoffs and the actual Super Bowl. And the Super Bowl is a social event that negatively impacts the local real estate marketplace, and probably everywhere, except in a lot of areas, you still have snow on the ground and the real estate market's slow anyway. Now we're flipping over and looking at overbids. This is what the buyers do when they come in and make their offer. Same concept, each line, here is where we were a year ago, and now we're here. So we're doing significantly more overbids than we did a year ago, and we'll step through. There's the peak from a year ago, and you can see it's more stable, but now it drifts down a little bit. And right about there's the bottom, and now it's gonna turn around and start coming back up again, and there's the current week. And the green dotted line and the purple line, green dotted line is next week, which is would be through Tuesday, but because I use a real estate calendar year of March 1st plus 7 days. And I'm right at that magic number now where we're at the end of February. And if I added 7 days, I would be on February 28th, but I need to get back to March. So this next week, I'm going to add 2 days. So that takes my normal midnight Tuesday, moves it to midnight on Thursday, gathering the data on Friday. I am going to eliminate this dotted line because it's only 1 out of 7 days and simplify it. And we're starting next week, we're only going to be seeing data through Thursday night at midnight instead of Friday night at midnight. Now what we're doing is looking at Silicon Valley. So we're just looking at Santa Clara County, San Mateo County, and Alameda County in a blender, and we're looking at each component. The colored lines here are the concept is the same. This is the hottest inventory because that's what we're looking at now is inventory. This is the hottest inventory level you'd expect. The gray line is exactly the median, the typical inventory you'd expect, and the blue is the most inventory you'd expect. A lot of inventory favors the buyer, which is why that's a blue line. Very little inventory favors the seller. You can see that we're basically following the pattern of the hot marketplace with basically very little. We are slightly above the line, so we have slightly more than 10 percentile of the inventory you'd expect for this time of the year. Here it is. We're basically, and now we're comparing it to the median. We took that gray line, stretched out the gray line, and then made the purple line be the data curving all over the place. And you can see you're maybe about 73% of the inventory you'd expect to have for this time of the year. Now we're looking at the number of offers. Here again, we have a low number of offers. And, I don't want to sound the alarm bell, but notice how this is sort of curving over. With the Super Bowl over, I would have expected this to go up. But keep in mind, we're going back 5 weeks in time. So 3 of those weeks are definitely impacted by the fact that the 49ers were still in the Super Bowl. We're going to have to wait and watch this line, but it deserves watching. I expect it's going to turn around and start falling more up with the gray line as we get more and more weeks past the Super Bowl. That's one of the disadvantages of looking at a long period of time, a long sample time of like 5 weeks. Any shorter than 5 weeks and the data starts to get erratic. Any longer than 5 weeks and it gets erratic. So it's basically a moving month, but instead of using a month or 30 days, I'm using 5 full weeks, so you have the same number of weekends and weekdays in there every week. So you've gotten rid of more of the statistical fluctuations by using a 5-week cycle. Now we're looking at the gray line stretched out, and you can see that your offers are below, and they're around 78%, maybe even lower than that, maybe 76%. And you can see they're dropping. Again, this is going back 5 weeks. So I'm assuming that as we get more of the 5 weeks past the Super Bowl, this number will look more normal. Here's your days of unsold inventory. And, this is a number that's more right in the present time, but here we're comparing it to the 10-year median. So you're faster than you typically are at this time of the year. So even though I'm concerned about the number of offers and the number of inventory, the ratio between the two is favoring the seller. So that sort of calms me down quite a bit. Now we're moving over and looking at that compared to the typical, and you can see you're about 92% of where you'd expect it to be for the 10-year. Here is the 75th percentile on the marketplace. So this is the 75th percent of the sellers. How long are they taking to sell? And you can see they're quite a bit below the gray line. They're above the blue. So it's, sort of a balanced marketplace, but favoring the sellers a little bit compared to our 10-year median. And here is that 10-year median pulled out on a curve. So you can see you're somewhere around 65% of the time on the marketplace. So sellers are selling 35% faster than they normally do at this time of the year. Here we're looking now at the seller's ask price reductions. So again, right on the gray line would be normal. We're down below. So sellers are taking more price reductions or larger price reductions, one or the other, than they typically do this year. Not dramatically, but it's maybe 1/3 of the way down, maybe even 50% of the way down between the typical marketplace and a favoring the buyer of the marketplace. Here's the gray line stretched out, and you can see that that average price reduction isn't very much. because we're above 99.5. I call that about 99.65% maybe. Here's 100%, 99% is way down here. This looks like it's at about a 0.5% reduction. So you're less than a 0.5% reduction overall. So that's the ones that take no price reduction as well as those that take a large price reduction. Now flipping over and looking at the sellers that take the largest price reduction. This is something you normally don't do in statistics, but if the vast majority of your sample size makes no price adjustment at all, I'm going out to the extreme and looking at the size of the price reductions. So the sellers that take the biggest 10% price reduction right now are taking about a 8.5% price reduction. You take 100%, subtract off something like 8.5%, that gives you about 91. So they're getting about 91.5% of their asking price. They're coming down 8.5%. That's a little bit more than the gray line, but not significantly more. You can see the red line. So even in a hot marketplace, our hottest marketplace, you'd still expect the sellers that are taking the biggest price reduction to be taking about a 5.5% price reduction. So even in a hot marketplace, sellers do take price reductions. Here's the same concept, gray line straightened out, and you can see that the price reductions happening right now are about 10%, maybe only 8% higher than normal. This is the frequency of those price reductions. So the frequency of price reductions are right on top of the gray line. So that has the previous answer. It's sellers taking bigger price reductions, not more frequent, because the frequency is right where you'd expect it to be. And here again, you can see the gray line stretched out. We're right at the gray line for the current week. If we were having a completely normal year, it'd be flat on this line. And you can see we've had no flat lining. You had a period here where you were close, but there's a lot of fluctuations. That's something that, when you start looking at the data regularly, you have those fluctuations, and it's nice to understand those weekly, monthly fluctuations, as well as the general over concept of whether it's a good time to buy or sell real estate based on the more trends. Here we're now looking at the average overbid. So the average overbid is slightly above the median. The gray line again would be, and it's the vertical straight down, so you'd be something like here compared to here. So you're seeing more overbidding, but nowhere near what you would be in a hot marketplace. Here's the straight gray line stretched out. So now you can see that you're getting about 1.75% higher overbid than you normally do. Here's the overbid frequency. Frequency, again, the frequency of it is right where you'd expect it to be. So more buyers aren't overbidding. They're just overbidding a little bit greater than they typically do for a 10-year median. Now, here's the frequency. You can see that you're somewhere around maybe 7% above. So even though it looked like you were right on the gray line, you're apparently 7% above. And it's a little, I'll go back to it. It's a little bit of an optical illusion, because when you have a line that's almost straight up, you have to go back to the center of this line and the center of that line. So it may be some number like 61% versus a number like 65%. So even though it looks like it's right on top, it's off slightly. So, which number is a bit more accurate of the marketplace? It's hard to tell. Clearly you're not up here at 40% more overbidding. You're only at somewhere around 7% more. Here is the long-term appreciation. So I just sort of did a estimate of where the long-term appreciation is. And you can see that every year you have this drop down. And I've said this every week, probably. The drop down happens every year. And it's not that property values drop. It's the fact that the type of homes that sell over the holidays, over the end of the year holidays, tends to be a different type of home. And that's why it's so consistent. And even here, it's flat, but instead of having a rapidly appreciating marketplace that we did in 2021, the market was appreciating so rapidly, it turned this sharp V into a straight horizontal line. Here's the number of active listings, and now what we're doing is we're comparing the number of active listings in each county. So San Mateo County is the smallest, and that's in the orange, so it's down here with only about 300 listings. Santa Clara County is apparently next at, maybe 475 listings, and Alameda County has the most listings at just about 575 listings. Here's the offers accepted. Santa Clara County has the most number of offers accepted. So even though it had less inventory, it has more offers. So it's a much faster paced marketplace than Alameda. And then San Mateo County is small enough that it has the least number of offers. And actually what you can sort of do is look To me, the big thing is, number of offers accepted. I don't know where you're gonna pick the line because you're at the steep part of the increase, but you're up here some number around 1,100 home offers accepted, and now you're down here at a number somewhere around 650. Days on sold inventory, you can see Santa Clara County is the fastest at about 23 days of unsold inventory. Alameda County is next at about 33 maybe, and then San Mateo County is pretty close at 34. So all three counties would be in a fairly fast marketplace, with Santa Clara being the fastest. Here's the time on the marketplace. All three of these are fairly close together, and I think this is true because of all the new listings that are coming on the marketplace. But again, if you look historically, no matter what time of the year you look at it, they're pretty close together. San Mateo County has been longer on the marketplace, mostly in 2023. This is the seller's ask price reductions, and you can see that Alameda County and San Mateo County are pretty close together. Santa Clara County has the least price reductions, historically fairly close together. Again, San Mateo County got hit a little bit harder in 2023 and had more price reductions. Here's the frequency of those price reductions. San Mateo County have somewhere around 7% of the sellers reducing their price, where in Santa Clara and Alameda County, it's almost 10%. Here is the magnitude of overbidding. So this is when the buyers come in with their offer. San Mateo County has the least with about 4.25% overbidding. Santa Clara County is second with almost 6%, and Alameda County is doing the best with about 6.25% overbidding. This is the frequency of overbidding. How common is the overbidding? It's the least in San Mateo County at about 57%. Second is Santa Clara County at 65%, and Alameda County at 70% of the sellers are getting more than their ask price. This is the long-term appreciation, and you can see that historically, before the pandemic, all three graphs were together. Now you come out and we hit the pandemic in March of 2020. How quickly we forget. I'm trying to think if it was March or February. But now Santa Clara County has the greatest amount of appreciation, and Santa Clara County and San Mateo County are very similar, when numbers somewhere around 160% for San Mateo. Alameda County is maybe 165%. Santa Clara County is 180. And when I say 180, that's 80% appreciation since 2015. I did not move the horizontal line, so I apologize for that. But you can see that San Mateo County is clearly the most expensive county now. Santa Clara County is, and Alameda County is the most affordable. The purpose of the horizontal line is to show you what segment of the market is potentially upside down, and also just to give you an idea when we first reached those plateaus, but they were not adjusted. This is the same information on regular paper. Here's the estimated payments. So the estimated payments are going to be in the same order, with San Mateo County being the most expensive, followed by Santa Clara, and Alameda County is the most affordable. Here's the actual raw numbers for each one of the three counties: Santa Clara, San Mateo, and Alameda, or Silicon Valley as a whole. It's noteworthy the Santa Clara County saw another 7% increase in the number of new listings. So we've had 1,000 new listings in the past 5 weeks, but we only have 464 active listings. San Mateo County actually went down and only has 413 new listings in the past 5 weeks. And Alameda County went up by about 1.5% and is at 849 new listings. But the total active inventory right now is this number here, which is more. And you can see it's going up 6% in Santa Clara County, 5% in San Mateo County. In Alameda County, it is dead even. And then you same concept with the number of offers. The number of offers are going up. The DUI is what you want to pay attention to. It's increasing, but not, one half a day, 3/4 of a day in a week is pretty small. And then here are your closings based on a 5-week period of time. And I have both the appreciation since 2015 and the appreciation since 2020, since the pandemic. And you can see that San Mateo County is only at 16% appreciation since 2020, where Santa Clara County is at 27 and Alameda County is at 27. Now we're leaving Silicon Valley and moving on to the Greater Bay Area, which is 5 regions. One of those 5 regions is Silicon Valley. Then you have San Francisco and Marin, which I call the cities. You have North County, you have Central Valley and the Central Coast. Just reverse order, throw up the numbers real quick so you can pick up whatever metric and county you're most interested in. And I also have the 9 Bay Area county here because the media talks about that a lot. And I maintain that that's sort of a garbage number because, nobody buys in the typical property for all 9 Bay Area counties. Here's your inventory. You can see inventory is rising in all 5 regions. But you can also see inventory is down from where it typically is, no matter which county you're in. So you have less inventory than you typically do, but the inventory is increasing. Same thing with the number of offers. A number of offers is increasing. But again, you have this sort of last week, one data point, and week doesn't make a data point, but at least it's worth paying attention to because these weeks here all had the Super Bowl, were all pre-Super Bowl, which would have been negatively impacted. So now that we have a week past Super Bowl, you'd expect the numbers to be taking off as far as the number of offers. So this is something to pay attention to. Here we're looking at days on unsold inventory. This is nothing unusual. The uptick here happens sort of every year. You can see it. Also, just a word of note, from January of 23 onward, the x-axis is spread out. So from this vertical line to that vertical line is 1 year. It's basically almost 3 years, 2.5 years historically. And I do that so you can see the long-term patterns back here, but that you also have enough room to see the current trends in the current years. Here's your days on sold inventory. You can see that they're all dropping. The one exception that I'm picking up is Central Coast did an increase. Could just be a statistical fluctuation. I would expect them to be going down at this time of the year. Here's the seller's ask price reductions. So here's your 100%. So that would be 0% price reduction. So all the areas are seeing less price reductions. So we flipped over from the end of the year with bigger price reductions to the beginning of the year with smaller price reductions. Here's the frequency of sellers' price reductions. So you're 60%, which would be a lot of price reductions. You can see that most of the numbers are somewhere around 20%, and Silicon Valley is down around 10% of the sellers are doing price reductions. This is the overbid. So what are buyers doing? Silicon Valley, the most overbidding at 6%. Cities next at 4.5%. North Bay is around 1% overbids. Central Valley is right about asking price, and the Central Coast is just under. This is the frequency, same concept. In general, the trend is up. So you're getting more frequent overbidding at this time of the year, all indicating the market's heating up. This is the long-term appreciation since 2015, all in an upward trend. Here is the sold price for each one of the counties, and this is going to be on regular paper. So you can see the cities is the most expensive, Silicon Valley second, Central Coast next, North Bay, and then Central Valley being the most affordable. This is the estimated payments going to be in the exact same order. With that, we've been talking about Silicon Valley real estate market geographically and graphically, plus the Greater Bay Area, 5 regions. This has been week number 8. You can get to the YouTube archive using the YouTube link right here in the blue, or you can use a shorter typing one of tinyurl.com/SVREMG for Silicon Valley real estate market graphs. If you want to add in 2024 at the end of that green URL, you get to the live presentation Saturday morning. If you add in H, the year 2024, the month 02, day 24, so it's all here. So the green URL plus H 2024 02 24, you get the handout. If you want a specific episode, you type in the green URL and the year, month, date code of the episode you want. I'm Richard Calhoun, Creekside Realty. My contact information, working with buyers or sellers since 1981 here in Silicon Valley. Happy to work with you. And with that, I'll open it up for any questions. Not seeing any mics, I'll do a explanation of the background of this data. The slides that are being shown in the background are the slides that we're going to be going over. The concept is real estate is local. So I've broken the Silicon Valley, the 3 counties, Santa Clara County, San Mateo County, and Alameda County, up into 20 different micro market areas, grouping similarly priced, geographically connected areas together to break the 3 county region into 20 micro market areas to better understand what's happening locally, because real estate is local. Not only is it in a micro market area, but it gets down to an individual neighborhood. The problem with an individual neighborhood is you have to start really comparing apples and apples. You can't do a statistical analysis of what the median price is doing. You need a large data sample to get away from statistical fluctuations. That is one of the issues I have with people that do zip code analysis. It's too small to be statistically significant, and some zip codes change quite a bit. Some zip codes have almost no activity in it whatsoever. So more often than not, you're going to get garbage in, garbage out. The time you'll get reasonable data is if the homes are fairly homogeneous and really don't change much. If you have a large range of the type of homes available in that zip code, the more likely you are to have statistical fluctuation. I developed these micro market areas when I was investing for my own benefit back in the late 1990s. I started in 1996. I actually started my first presentation in September of 97. The whole focus is trying to understand the market. So what do? I look at roughly a dozen different metrics. I have some unique metrics. I look at the seller price reductions. That's significant because now you eliminate the delay of needing escrows to close. What it does is it basically is saying that if a lot more sellers are taking larger percentage in price reductions, either more sellers or larger amounts, the seller's expectations were higher than the market, and the market's probably slowing down. And then as sellers take fewer and smaller price decreases, they probably underestimated the market. It's not an ideal metric, but it gets away with eliminating the time to close escrows. Once escrows close, you sort of have a 5-week, 6-week delay. Then you can look back and look at the overbidding. So how much are the buyers coming in, magnitude and frequency of overbidding? I also look at what the key components, inventory, offers, and more importantly, the ratio between the inventory and the offers. And I compare that to the 10-year median. And the reason I do that is each micro market area is different in size. So you can't just look at raw count. So by comparing the current reading of the current week to the same week for the past 10 years, you get an idea whether there's more inventory or less inventory than normal. I also don't look at things on a monthly basis as most people do. The reason I do that is I take 5 weeks instead. Back in the 90s when I started this, I looked at 1 through 7 weeks and looked at which was the most stable, and turned out 5 weeks was the most stable index, and that's why I picked a 5-week benchmark. It also mirrors a month more accurately. The problem with a month is some months, like the typical February, you have exactly 4 weeks, and some months are 30 days, some months are 31 days. Each month is going to have a different number of weekdays and weekend days, and more importantly, recordable days. Recordable days are days that the recorder's office is open and ready to record real estate transactions. All that has an impact on the real estate marketplace. More importantly, the real estate marketplace is driven over the weekends. Buyers typically are going to be going out on the weekend, looking at homes, writing up offers the following week. So there's a huge weekly cycle. So the monthly data, it depends on how many Tuesdays through Thursdays there are in the month versus even Mondays and Fridays when less activity is reported to the MLS. By using whole weeks, I get rid of that huge weekly cycle. I also look at, instead of just the median sold price, I look at the 10 percentile and the 90 percentile. So the price in each micro market area is sandwiched, so you know what the price range is for a given area. I also put it out geographically so that you can see visually the impact of the pandemic, where you're having a huge change. I was the one that introduced the days of unsold inventory, but the whole concept of the speed of the marketplace was introduced by myself. I was looking for tools to better understand the marketplace, and that's what I have focused on during this whole presentation, because there's a whole bunch of assumptions that you have to make. Was something a typo error or was it real data? I try to collect typos. A typo might be someone listed as a home for $14 million instead of 1.4 million. And what I do is I try to look at huge changes between the current list price and the original list price. I also look at the long-term appreciation, not only from 2015, but also from 2020. The 2020 gives you an idea what has happened since the pandemic. The 2015 gives you a better long-term picture. I also look at the distribution, the weekly distribution, which is a 5-week data set, but it changes every week, of the overbidding as well as the seller ask price reductions. So the whole concept is to have you better understand the real estate market. It's the biggest investment you're going to be making in your life, whether it be your first home or your third home. And the more data you have, I believe information is powerful and lets you better understand the market conditions so you can make better choices. Happy to work with buyers and sellers, not in the same transaction, so buyers or sellers, and happy to have a consultation with anybody. Feel to reach out to me. My contact information is on every slide. I'm Richard Calhoun with Creekside Realty, broker here in Silicon Valley since 1981. Happy to discuss it. My email and phone number. Prefer email, but we'll take phone calls and also text messages. Thanks. Take care. Bye for now.